You're listening to the Real Estate Runway podcast, powered by QUATTRO Capital, where we are all about alternative business and investment strategies to help you amplify life and maximize wealth. Here's your host, the recovering engineer turned multifamily investor, Chad Sutton.
All right, Real Estate Runway family. Today we're going to have the one, the only Toby Mathis with Anderson Advisors, who is an investor owner, tax attorney, been doing this for a long time. He's a long-term investor. And we're going to talk a little bit about his thoughts on where we are today and where we might be going. So let's get right into the episode. Before we do, if you get any value out of this show, folks, interact with the show. Like it, subscribe to it, share it, write a comment. Any of those things will help us get to more people just like you. So pay it forward. We put a lot of time and effort into these shows to benefit people just like you learning how to invest in the real estate world. If you want to be on the show, you can apply at thequattroway.com/podcast. We love having people like you on to have great conversations, just like we're about to have with Toby. And check us out on social media. We are on TikTok and YouTube at Real Estate Runway Podcast, or Instagram, Facebook, LinkedIn, all the others, Twitter, or I guess now X.com, at Team Quattro Capital, one word, no special characters, or just visit us at thequattroway.com. If you want to look at how you can work with Quattro Capital from an investment perspective, check us out at thequattroway.com/invest. to sign up and see if that we are a good fit for you. Without further ado, let's get right into the episode. Here we go. All right. Real Estate Runway family, welcome to another episode of the Real Estate Runway podcast. This is your captain speaking. We're taking off on another awesome episode today. We've got a long time guest we've been chasing here to get on the show. So you are blessed to get to hear Mr. Toby Mathis here on the show with Anderson Advisors. He's an attorney investor. Toby, welcome to the show. How are you doing, brother?
Hey, I'm doing great. By the way, I'm looking out over the Pacific right now. I'm in Kona on the Big Island, just looking out over some beautiful waves. And I like to set up my little podcast studios wherever I go. So this is a kick. So I think my view is probably better than yours.
Yours is much better than mine. I am overlooking a pretty golf course in Nashville, Tennessee, but I think he waited until we started this episode to tell me that, folks, because I love the Big Island. Mauna Kea is one of my favorite places to visit. Holy smokes, I'm jealous of you.
It's good. I think it's Uma Bay. Yeah, I'm just looking out over the water. It's just gorgeous. And by the way, the Hawaiian people are just the nicest people.
They're amazing. Yeah. And as of this recording, again, our hearts go out to those experiencing the fires over in Maui. It's a devastating thing. We actually have a friend that lives over there, who you probably know as well, and good to know his family is safe. But
the relatives here, like a lot of these extended families, and we'll see the aftermath in the coming months. We'll finally figure out what actually transpired and how many people were affected. But it's significant. It's really sad. It wasn't just Maui, but they had fires on the Big Island. They had fires on Oahu.
Oh, really?
Yeah, it was just the wind shifted, and apparently the conditions were just ripe to allow this thing to take off. It's horrible loss of life. Heart goes out for all those folks.
Yeah, it's absolutely horrible. And interestingly, to bring it back to real estate, which we're not going to talk about this today, folks, but it is going to be interesting to see what happens to that land now. This is when the dreaded developer gentrification term is born, and people will try to come in and buy up the land and develop something that will price the locals out. And so I'm not dogging, there's good and bad to that, to redevelopment, but that will be a challenge that the people will have to face, is what comes after.
Anytime there's a disaster, when you had Katrina, you saw it. When you had Houston get hit with a hurricane and you had that massive flooding, you saw it. There's always people that are opportunistic, and it's just taking a beat and giving people the opportunity to not have to sell under dire circumstances. Because a lot of these folks are looking for a place to live, and they have the property that just got destroyed.
Yeah, I hear you. Toby, let's jump into the episode at this point. Before we get into kind of our meat today, tell us a little bit about yourself. Tell us about your journey. You were in the asset protection, accounting, and legal world, all things affected real estate. You've got a pretty thriving practice there, I venture to say. And you're also, which is why you're on the show here, an owner investor in real estate. So I can't wait to hear what we're going to get into there, but tell us about you and your journey.
Yeah, I could actually, you'll understand me if I give you a little bit of my background. So I'm a tax attorney. I've been doing this for, 25, 26 years now. Yeah, 26, going on 27. But I didn't become an attorney to practice courtroom law. I became an attorney because my mentor at the time, a guy named Jerry Getty, he was practically like a second dad to me, said, hey, we need to all go to law school. These lawyers are screwing up our business. And so his son, himself, and I all went to law school. His son's a fantastic attorney in California, and I do this. The dad didn't make it 6 months into law school because he liked to raise his hand and tell the professors that they were full of it. So he got invited to leave. But what was so interesting is he introduced me to somebody back in the 80s. I don't want to date myself, but it was a gentleman who owned a bunch of property. He lived in Peoria. His name is Boyd. And he had this list of properties, hundreds of properties that he owned in Seattle and in Denver. And I remember looking at that going, man, this guy's rich. And he was a pretty chill dude. His office was a real estate office, small house that was converted into an office. Guy wore gray slacks and a white button up every day. And he was just innocuous, but it didn't hit me until probably 10 years later what he was actually investing in. He wasn't investing in the real estate. He was investing in the cash flow. Mm-hmm. All I could think of is how much are those houses worth? And I don't think he cared what the houses were worth. What he cared is what they produce. And from that point, I was like, boom, I started to realize things. A lot of it is about income streams. It's about having multiple streams of income that are perpetual, that grow over time. You end up with very few asset classes that can do that. You're looking at dividend stocks, you're looking at maybe writing covered calls if you're a stock market person. And if you're in real estate, you gravitate towards cash flow real estate, which is going to be in the form of single family, multifamily. Commercial, I've just never liked. Some of you guys are probably commercial folks out there, but I have some. My partner and I own over 400 individual pieces of property, ranging from apartment buildings to commercial buildings to a lot of single family. But we're avid investors and we do exactly what we teach, and which makes it really easy because I could tell you, hey, you don't want to pay tax. Here's 3 strategies. You could do this and this. And somebody says, are you sure? And I'd be like, yeah, I've done it multiple times. And I have tens of thousands of clients across the country that have probably done it. Our firm has over 500 people. We've been doing this for, again, 25, 26, whatever it is, years, more than 20 years. And we work primarily with real estate investors. I have some business owners, but our focus is real estate, asset protection, and tax. And I'll give you this word of caution. Like, Chad, if I was ever going to give one piece of advice to anybody, it would be this. If you're going to have a professional, make sure they do what you do. If you're going to work with an attorney, you're going to work with an accountant, make sure that they're doing real estate, because the nuances that you learn by doing it are significantly different than what you read out of a book or what you'll ever get practicing. You have to do it. You have to understand what it's like to get a phone call at 1 a.m. that a toilet is clogged, because then you'll be like, wait a second, I don't like that phone. How do I make sure I don't get that phone call, right? There's things you'll put in place. Or unfortunately, if you start investing in real estate, you're going to have liability occurrences. You're going to have discrimination suits. You're going to have those things. How do I buffer it so that I'm not feeling personally attacked? How do I get it to the point where if there's a lawsuit, it's no different than if a tree fell over and hit a property, which I've had. I've had properties burned down. My first instinct in all those cases, because we're structured, is how's the tenant? Are they okay? Right? I don't have to worry, oh, crud, they're going to sue the lightning out of me, because I already know what my exposure is. I know ahead of time. And again, that's what I would tell anybody, is just make sure you're working with people that get what you're doing, because otherwise someone's going to be learning on your dime.
Yeah, and that's an expensive lesson that you'll have to pay. Ask me how I know. I've been there as well. But I can echo that. The having professionals who do what you do and having the right structure in place to look, I've owned not as much property as you, but a lot of property. And everything that can go wrong has gone wrong. We have had trees fall on cars. We've had roofs blown off. We've had a building burned down, and it was unfortunately not an accident. So there's been things like that. And that's, to your point, early in the career, I remember, I'm still young enough to remember, Toby, when I was like, oh my God, we're getting sued? What? Now you're going to get sued 2 or 3 times a year if you're a property owner. It's just part of the job. And you have insurance and all that kind of stuff. So I appreciate that sentiment. Toby, let's get into a little bit of the meat today. And so folks, listen up, get on the edge of your seats here, because we have a real live tax attorney and a real live investing professional who not only does what he does for himself and his own growth of wealth, his clients as well. So we have someone who has quite literally an inside look on many of the larger real estate companies in the country, being with Anderson Advisors. This is a major firm we're talking about here. So let's talk about just what do you see in the world today? Like, where are we? We've been talking about inflation, interest rates, liquidity, loans coming due, mayhem coming in the real estate markets. There's a lot of news and a lot of noise, but from someone who's on the ground and has insight to everyone else's business, what do you see today? Let's start there.
Yeah, Chad. So nobody has a crystal ball. That's first off. So people that just so they say something loudly doesn't mean it's true. Just because they say it with conviction doesn't make it so either, right? So you have to look at the facts, and the facts are pretty simple. In the last 10 years, we've been not keeping up with population growth as far as buildings. So we're underbuilt in a residential market. We also, fact-wise, is we've seen property values increase significantly over the last 10 years, to the point where we have about half the property values, which if you look at the median home, it's over $400,000 in the United States, but half of that's equity. When you start coupling those facts, you realize, wait a second. Everybody's predicting this real estate crash. And by the way, everything I say, a lot of it's recorded. So you can go back and look at my YouTube channel and see what I was saying a year ago, 2 years ago, 3 years ago. My charts are all there. Like, it's not rocket science. You're looking at it going, hey, there's not a lot of inventory for homes. Like, we're at record low. I wonder why that is. 40% of homes, 40% are being bought by investment firms. I wonder why that is, being bought for cash. The baby boomers are the only ones in a position to be buying. So like, they're the only market right now. Everybody else is sitting on it. Why are they sitting on it? Because the vast majority, I think it's as high as 90% of the loans out there are fixed. We're not in 2008. Anybody who starts screaming it's 2007, 8 again does not know their facts. So it doesn't back it up. So we've been saying this for 2 years, that inflation's rampant. It's the M2 money supply. If you just go get one of your charts, go to Y charts or one of those others and go M2 money supply, the money supply in the United States, and then map it against residential house prices. It's an identical graph. They're almost identical. So what happened? The federal government did all these things during COVID that necessitated the printing of about $4.2 trillion. What did that do to home prices? It drove them up. Why? Because inflation pushes up assets. Inflation and growth are the big key. Those are your denominators. What did we have? We had supply chain issues. So companies were able to charge whatever they wanted for things. We had massive demand for everything from wood to try to build things to the actual house, the end house. So what is it going to do? It's going to drive prices up. Rents were trailing. I think rents have a ways to catch up to the home prices, but we're still in that situation. People are saying, oh no, it's going to crash this time. There's good data that says we're between 5 and 7 million units behind in the United States for residential units. You have investment firms buying up about 1 out of every 3 houses right now that are being purchased. I don't think that housing prices are going to be crashing anytime. And you have a ton of equity. This isn't 2008 where people were underwater. This is 2023 where you have a ton of equity. We're not going to see that crash. We might see corrections, but we're not going to see a crash. And builders, because they read the news and listen to the news, they get scared and they stop building, and interest rates start going up and it becomes more expensive to build. And they start saying, hey, you know what? I'm going to build only certain types of housing and I'm going to restrict myself on what I'm building. And now you've exacerbated the problem because you're not building fast enough. We haven't been building, like we're probably 500,000 units behind per year for the last 5 or 6 years. If you look at the Harvard Joint Center for Housing, they have good data, lots of data sources that suggest that we were not keeping up with growth. We see growth, I think it was 2019, you're talking about 2.1 million households per year, and we're building 1.5, 1.7 million units. We think that we're keeping up because that was the estimate, but we're not even close to the reality. We're still underbuilt. That problem is going to surface in so many different ways. We're going to see mass homelessness. We're going to see lack of affordability in houses, and you're going to see people really starting to get horribly affected. We're already seeing it, where they just don't feel like there's any money at the end of the day because they're so burdened with the cost of housing. And then I put on my capitalistic hat and say, how do I solve it? What can I do to be part of the solution? We can be part of the solution by investing in real estate, keeping it away from the funds, being a good person. Like when I have a property, and you're probably in the same boat, but if I have an older tenant, and I had a gal that was 82 and a tree fell in her house, What I can do is say, here's a different house, and I'm not going to raise your rent, or I'm going to lower, or I'm going to cover the cost of things. If I have a disabled vet, I can just say, I'm never going to raise the rent on this. And I can do that. A Blackstone or BlackRock can't, right? Some of these groups, their duty is to their shareholder, and they have a fiduciary duty to maximize the revenue. They can't do things like that. If I want to do transitional housing, for example, for folks that age out of, blank on the word, but
foster care type thing.
Foster care,
Big need,
yeah.
by the way. Yeah.
Huge. But if I'm going to get into that area, if I'm going to do neurodiverse living, autistic children, or anything like that, if I'm going to adults that they can't live on their own, right? If I'm going to get into that, I can do that. I can do that because my motivation doesn't have to be primarily the money I'm making. But if you are in an equity firm or you're in a fund, their duty is to the folks that invested with. They can't do a lot of those things unless that they can generate enough revenue, in which case then the prices start going up, right? I look at us being, as investors, you and me and everybody listening, that we are in a unique position to where we can do good and we can still do well, if that makes sense. We can do good things. We can do shared housing. We can be very creative. We can do things for other people and solve their issue. And we don't have to gouge them, and we don't have to be just capitalists. We can actually look at other motivations.
I love what you ended with there, Toby. And that is literally like, folks who've listened to this show, we have 4 pillars of Quattro: people, property, profit, and philanthropy, coming back and taking care of people. And that's what it's about. It's literally written in our pillars as do good while doing well. That it's a concept that I don't think people have realized is available in all cases. You don't have to do well. You don't have to screw somebody else. It doesn't have to be you win, others lose. There can be win situations. And I love what you just said there, just ending there.
We have a scarcity mentality in this country.
We do.
And a lot of people feel like if I don't get mine at the expense of somebody else, I'm going to be hurt some way.
Yeah. I think we've quite literally proven that money does grow on trees. We can just print more, so it's fine.
Absolutely. It doesn't even have to get grown. We could just conjure it up and put it in.
Print it. Yeah.
It's just add a zero to that account.
Yeah. It's not even printing anymore. It's just a button click. But anyway, you said a lot of really good stuff there, Toby. And folks, going back a little bit to where he was talking about the line of asset prices and M2 money supply, said another way, it's like when we print money, where does it go? Well, this came out via stimulus, so it went to people's pockets, right? 98% of the population, where do they put that money? They go put it in the bank where their bank account is. And if you've listened to me drone on about this at all in the world or on these podcasts, anywhere that I'm recorded, you've heard that I talk about the fact that bank's the best business in the world. They can lend the same damn dollar out 10 times before they surpass their limits. And so, like, you think about that, what does that mean? Immediately, people had more money they could spend. And immediately, banks had a lot of money they had to lend. If that money isn't lent, it's not making money. They're in the business of making money on other people's money. Best business in the world. And they can do it 10 times over. And so what happened? People said, gee whiz, rates are low. I've got more money in my pocket. Let me go buy a bigger house. And then the next thing you said, the cost of ownership. There's another graph out there you can pull up on Y charts or even Fred.com. And quite literally, it shows the cost of rental index versus the cost of home ownership. And in a similar fashion, as rates have run up, that cost of home ownership line ran up in a vertical, because guess what? When rents go up, cost of mortgages go up. And therefore the cost to own the same type of house is now through the roof. So we have a huge disparity, back to your point, on all the things. And so go ahead.
I just want to interrupt you there, because that's probably my favorite graph that I use. Is actually I do a ratio of the cost of a single family home versus the rent of a single family home to determine whether or not our economy is going wackadoodle, right? We saw a massive run up in 2006-07 of the price of a home, but the rents did not support it. In other words, if I end up not being able to pay my mortgage, but I can immediately get rents that cover that mortgage, no harm, no foul. I'm not being foreclosed on. But if the value of the home that I'm getting a mortgage on is so high that the rents don't support it, then you have problems. And we saw the graph get really wonky in 2020. And it was enough to make me go, crud, prices of houses are going up too fast. But there's 2 things that happen when that occurs. Number 1, house prices get yanked down. Number 2 is rent prices get yanked up. And what we're seeing is a combination. We did not see enough inventory for house prices to get yanked down. So what do I think's happening? I think you're going to continue to see rent prices go up. The problem we have is wages aren't keeping up fast enough. So you're going to see the rent burden and the cost of shelter skyrocket. And I don't think inflation's done. I think what we're going to see is, and I hate to be predictive, but if I could see a scenario where we're back in the 70s again, where you're going to see inflation start to run like crazy again. And the problem is we have a government that isn't prudent. They spend way more than what they bring in. And every time they have to print more dollars, and I know it's not the government that prints the dollars, but your cash gets devalued. But on the flip side, your real estate gains more value.
Right.
The problem that we have is interest rates. So as an investor, you're always looking at cap rate, but then you have to look at the cost of debt. And when you raise the cost of debt, you devalue the asset, the underlying asset, the real estate itself. So I don't know. I don't have a crystal ball, but I certainly see pain in the future for folks that are not investors or don't own their home, because they're going to be at the whim of whatever the world is demanding for rents. And I could see that continuing to escalate. I see that being like, oh my gosh, house prices aren't coming down. They're stabilizing. Now they're starting to go up. If they start lowering interest rates, because the Fed's going to do a pause here, then they're talking about lowering interest rates. It'll be interesting. Very interesting. I think you see inflation as a result.
This is a fun conversation. And so we're going to go off script here, because I think you and I are going to have a good back and forth on this, Toby, with what you're talking about here. So we have one of two situations that may happen, right? So we know that today we're pulling money out of the economy. We're raising interest rates, which is all coupled into quantitative tightening. We've all talked about that.
Mm-hmm.
And to your point, let's zoom in a little bit. The residential home market, like we know the supply and demand is screwed up for a long time to come. So it's likely that the prices will continue to rise, and they have been, just at a lower rate. Let's think about the buyer psyche, right? If you're already in a home, you're like, well, I'm not moving right now because I got 3% rate and I feel good, even though your family's still growing. And so that pressure will still be there. I know I've got it, right? And so what will probably happen is interest rates start to go down, and those people who will come off the sidelines and start buying again. Enter demand. Supply is still short. Prices will go back up. Basic economics. Now, the interesting thing that I'm curious your thoughts on are the supply and demand is there. The fundamentals are there, I think, for a long time to come. We're not catching up. And honestly, these builders we were talking about, even the best ones, they were burned so bad in 2008. Many of them will be very cautious for a long time to come. We just never built enough coming out of that recession while we are where we are, partly. But let's talk about the impact of interest rates for a second. We're thinking that demand is going to still be there, and we're thinking that good real estate is still going to probably trade pretty well. But where do you think people are who have maybe they had long-term fixed rate debt and it's just unfortunately coming due right now? Or maybe they did short-term debt and they unfortunately maybe have a balloon payment to deal with or something like that. Do you think we're in an instance where lenders are going to start threatening taking back assets or forcing sales? Or what do you think that's going to drive right now? Because that's more of an investment real estate question than a market in general.
I think it's a really small percentage of the loans that are not fixed. And in the market, as far as the balloons, and I know what you're saying, that, hey, I honestly think it's like such a small amount that it's not going to have a big impact. But there's probably smarter people out there than me that have dug into those numbers. But what I'm seeing is people that can't move because the loans are too low. And if you start lowering interest rates, every time mortgage rates drop, let's say in the future, let's say it's next year, you're going to have more of those people that come off the sideline and say, now it's worth it for them. But the only market that I see that has the balloons, that's going to just they're just going to get wiped. And I don't think I'm in the minority on this, is commercial. And you're talking about $1.5 trillion of debt that's supposed to come due in the next couple of years, where there's balloons that are going to have to refi at these new higher rates. We're talking about twice as much. The cost of the debt's twice as much. A lot of these projects, you're going to see, I think we've already seen it. You're going to see full-on projects where they just hand it back to the bank and say, here, you're already seeing it in San Francisco. I think you're going to see it elsewhere. And the scary fact is the actual utilization rate. Most major cities, commercial real estate, we're talking about office buildings, things like that.
Some retail centers, but mostly office, I think, is the hardest hit.
It's about 50%. They're just not using them. So I don't know how that gets buoyed up. I guess the good news is they're not building, right? There's not a lot of new inventory being put out there. So it's okay. So some inventory is being retired. Every year, more inventory is being retired. Great. So they're not exacerbating the issue, but I don't think they could wait this one out. I don't think that it's going to be a situation where
they've been waiting it out for 3 years now. Right. And so I think you're starting to see major companies like BlackRock and players like that say, you know what, I'm tired of throwing money into this money pit black hole. And they're trying to hand the keys back. And in some cases, the lenders say, now they're saying, well, hold on a second. They're changing their tunes because they don't want it back. That thing is like, the only way you want a property back if you're a lender is if you can recover their loan proceeds. And like you said, some of those properties are worth 50 cents on the dollar and the loan was at 80 cents on the dollar. So even the lender's underwater.
And here's the discipline. So for anybody out there that's thinking of going into some of these distressed funds, be very disciplined, because a 30% discount sounds great, but the actual discount might be 75. And all of a sudden you get taken for a ride too. We saw that in 07, 08, 09, before everything bottomed out. I was in Las Vegas. That's where I live. And we saw a 75% reduction in the residential market of values. Now, 10 years later, you're fine as wine. But at that time, people that were leaning into it and trying to buy when things were 30% down, 40% down, got smoked, right? Because it just kept going down. So you got to be patient and you got to work with people that really understand the assets that they're acquiring. Me, I'm a cash flow guy. I honestly don't care what I paid for a property because I'm never going to sell it. That's my mentality. I have an infinite mentality. I'm going to have this thing for 300 years. So if I'm going to buy a property, I want the cash flow and I want that cash flow for my kids, right? I just want to have cash flow coming in. I think more people are starting to think like me. Whereas a lot of folks were always, hey, the market's going up so fast. If I get in here, I fix this up, get it to produce more, I'm going to double my money and I'm going to get out. And now their money's doubled and they're going, okay, now what do I do with it? Everything's so flipping expensive. And so you're starting to see more people focus in on that cash flow, which again, I think that's going to be the thing going forward, is that the smart investors are going to do that. They're going to be looking at it going, I'm buying an income stream and I'm not looking to exit in 2 years, 3 years. I'm looking at an income stream for a lot of years, perpetual. Best case scenario is we just hold these assets, maintain them, improve them periodically, make sure we have a good CapEx, and everybody enjoys that cash flow for years and years. And when you buy it, you get a nice big fat tax deduction if you're doing it right.
That's right.
Your cost sag. And there's always, that's like a little discount. It's, hey, here's your discount code. You get a big tax write-off. You're not going to pay tax on the rents for 10 years, or you're going to wipe out a bunch of your other passive income. Or if you're a real estate professional, you're going to wipe out a bunch of your other income. That's just the bonus. But the real focus, in my opinion, really should be on that cash flow.
I love the way you said that. And I was actually about to transition to that point. So you knew our conversation so well, you went there on your own. It's perfect. And honestly, folks, look, people say cash is king. I venture cash is king, credit is queen, but cash flow is the ace of diamonds, right? With that buddy in your hole, you don't have to look at selling your project. And to your point, that's where you can get yourself in trouble, is always looking for the next exit, because then you become a flipper. And as a flipper, you're only as good as your last flip. You can lose it all in that last flip. So yeah, real estate, folks, it really is at least a 10-year game. If you're going to do it right, and I'm talking to you individual investors out there, you really want to be looking like, let me at least hold this property for 10 years and preferably in perpetuity. I know as a syndicator, it's a little different, because as a syndicator, you're like, okay, you make money by flipping people's money, right? And so it's almost like a buy one, get one mindset. You try to put money into something at a low basis, do some work to it, improve it, get a quick 3 to 5 year exit, double people's money, take a nice fat promote, and then go put that into your long-term property. But that game's tough right now, because it's like, if you're banking on an exit, it ain't happening for a while.
And I always look at it as, I want that income stream.
Yes.
And I think it was Warren Buffett. I like to use goofy quotes, but he had something that he says in the stock market, which, if you wouldn't own it for 30 years, don't think about buying it for 30 seconds. Right? If you're looking at an asset and you're looking at it going, oh, this is just going to be a quick hit. I've done that. My worst deal was that. Like I saw these people and they were going to, because I'm not a flipper. So I hate flipping, but it was a bunch of my clients that got milked into trying to do these flips, and the numbers didn't work. I gave them the exact calculation. I don't buy anything. If I'm going to do a flip, I can back test my clients and say, here's how you make sure you don't get blown up. And so I say, you got to buy it after repair value. You got to buy it for 60 cents on the dollar. That's what you're going to have to buy it for and fix it up to be safe. And all these guys jumped in there at 80, 90 cents on the dollar. And then I bailed them all out is what I did. But I was like, so I call that my worst deal because I was like, I'm buying a crappy thing that I would never have bought in the first place. But I felt like that's not where these guys need to learn. I was like, hey, I'll bail you out. I'll make sure you guys get a little profit and go on. I can stomach this because I always figure in real estate, you're 10 years away from fixing a problem, right? So I always look at it. All I got to do is be patient. I had the funds. I wasn't too worried about it. I was like, this thing's going to be fine, but it's going to take it a while, right? Not the best use of my monies, but what the point of it is they were looking at the short term and they never considered the long term. My exit is always, or like my worst case scenario, you're buying a house for you and your family. Your worst case scenario is what can I rent it for? And does it support that valuation? If you buy on cap rate, everything that you buy, if you start focusing on cap rate, you won't get hurt, or it's unlikely. Like the chances are way more in your favor than alternative. If you buy on comp, you're going to get beat up. And a lot of folks buy their house on comp. And what I mean by comp is whatever the houses are going for in the neighborhood. If I looked at that and said, hey, I only want to buy things that would cash flow, then even if I bought a residential property, I'd make sure it cash flow. If I can't live in it, then I'm not going to get hurt. And what you saw again, when we saw the market crash, it was because the rents didn't support those valuations. You couldn't buy them on cap. So none of the investors were buying your house. They didn't want your house. 2007, 2008. Right now, the chances are they don't want certain houses, but there's a lot of houses that they'd be like, yeah, give me that. Many of them, as soon as you list it, they're buying it. How do I know? Because 30 to 40% of the properties out there are being bought by the funds because they cash flow.
I love that. Toby, we could talk about this all day, but I've got you for 5 more minutes. So we're going to pivot into the Quattro questions. Are you ready? All right. Number 1, what's your superpower in life or business and how does it serve you well?
Teaching. I love to teach and I love to I don't care where or what time or whatever. It's fun to share experience. And I'm a believer of the Gestalt method, which is you teach from experience. You don't teach from a book. So I don't like the college people. I get a college professor that hasn't actually run a business. I don't really have time for him, but you give me somebody that built their business and exited it for 200 million. I'll listen to them all day. They're like, hey, what else happened? What was this like? What was the private equity like? Again, I just love the experience. So my superpower is I'll teach anybody anything, anytime. That's based off of my experience. I love to share experiences, but then I'm going to ask for them to share too.
Yeah, mutual respect there. And it's very self-evident by your interview we've done today. You're very much a teacher. So let's flip the coin over, Toby. What's your biggest failure or mistake in life or business? What'd you learn from it?
I don't know if it's a mistake. I think that when you trust people, there's a certain amount of, you're going to catch it in the teeth once in a while. So I sometimes I'm a little too trusting of folks, but then again, I'm an asset protection attorney. I always moderate risk. So when you do get hit, it's never fatal, but you still get disappointed once in a while where you're like, okay, I gave this person the opportunity. Why did they it's almost predictable. A little bit of that greed things goes in, or sometimes I see it over and over again. And I live in Las Vegas, right? If you have a vice, there's somebody that will cater to it in Vegas, right? And it'll smack you around. So you're like, oh, I hope this person doesn't go that direction. But then when they do, you're like, it's not entirely surprising. And in the world of business, there's people that get greedy. And I'll always give somebody a chance, but every now and again, you're just like, ugh.
I feel you there, man. All right, let's jump to philanthropy for a second. So as the listeners know, philanthropy is one of our 4 pillars, coming back and taking care of people, which is our first pillar. I love to give my guests an opportunity to share that heart and talk about where do you like to give your time, treasures, and talents. And if there happens to be a link, we'll put it in the show notes. People sometimes will co-give with you. So what's that for you?
Yeah, I give my time to 3 different charities. One of them is King's Ransom, which I sit on the board of that organization. Danny Johnson put that organization together, and I imagine some people know of it. It's feeds the poor. We work with the trafficked. We work with Israel and India and South America, and it's just a really cool organization. I'm blessed to get to be a part of it. And we see millions of dollars go to these organizations. And my job is to be a good steward to make sure that you're vetting out the organizations that get the money and make sure the money gets to its place. It's almost entirely volunteer driven. So there's not an admin cost on it, but I love doing that. I have a sanctioning body in Vegas. I love Muay Thai. So if kickboxing and boxing, I have a sanctioning body there. And I've been doing that for years where we sanction bouts. So if you've ever seen Lion Fight or some of these others, we do mostly the stuff the Nevada Athletic Commission doesn't. So like a lot of the amateur fights and things like that, we're the sanctioning body on if you're seeing Muay Thai. And then I have a stewardship group that it's really just where I like to give houses to folks that make it low income housing, which isn't really low income housing. It's really Section 8, things like that actually qualifies. But it's a nice way to get a big fat tax deduction because you get to write off the value of the house when you donate it, not what you paid for it. But then it's in that charity in perpetuity. Nobody can ever take it away. It doesn't matter if I die, the thing just keeps going on and it's helping a lot of people. So I like doing those things.
That's amazing, Toby. I love hearing about that. And so last question is pretty simple. What is the best way to get in touch with you? I know you have some expertise and some services that may be appealing to those listening to this episode. How do we find you?
Yeah. So easiest way to get a hold of me, real simple, Chad, is just type in Toby Mathis in any internet browser and you're going to find my YouTube channel.
Perfect. Toby, thank you so much for coming on the show today. Just talking about the long game and how, folks, it's going to be okay. Okay. And even if you're having a tough time right now, reach out to me, to Toby. We're all willing to help. Anyone who is in a tough position, there's probably a way around it. All right, everyone. This has been another episode of the Real Estate Runway podcast. Until next time, over and out. All right, Real Estate Runway family. I hope you enjoyed that episode with Toby. He is just a wealth of information, a teacher at heart, and just has a lot of experience in this world. So glad to have him on. Glad to talk a little bit about where we are, where we might be going, and just get to the big picture a little bit. We're having some turmoil today in the debt markets, but long term, we have a bright future. So if you're having any trouble in this world today, if you're struggling with some deals you're in, give us a call. I'd love to see if we can help you out somehow with some gap equity or something of that sort. Without further ado, let's end the episode today. This has been another episode of the Real Estate Runway podcast. Until next time, folks, over and out.
We hope this episode was insightful and brought value to your day. If so, please be awesome and leave us a 5-star review. Find out how Team Quattro can help you at thequattroway.com. Until next time, this is the Real Estate Runway podcast.